It is 1998, and a fund called Long-Term Capital Management is packed with Nobel Prize-winning brainpower and a record that looks almost magical. Then a crisis hits Russia, spreads through credit markets, correlations jump, liquidity dries up, and the fund is suddenly facing losses that its models said were nearly impossible. Here's the question I want you to sit with tonight. When the world stops behaving like your spreadsheet, how do you decide what to do next? Most adults think the hard part of markets is finding the right answer. The real hard part is making decisions when you cannot know the answer. Uncertainty is not just risk you have not measured yet. Risk is the range of outcomes you can roughly map with probabilities, like the chance a diversified stock portfolio has a down year. Uncertainty is when the probabilities themselves are unstable, like a regime shift where the rules change and your past data becomes less useful. In markets, uncertainty is the water we swim in. When I place a trade or make an investment decision, I am not choosing between true and false. I am choosing between distributions. A distribution is a spread of possible outcomes, some good, some bad, most in the middle. The mind hates that. The mind wants a story. The mind wants a single forecast. That is where psychology quietly becomes a risk factor. Start with the most common mental trap. We confuse signal with noise. Signal is information that helps predict outcomes. Noise is randomness that looks meaningful in the moment. In a bull market, noise feels like signal because everything goes up and your brain rewards itself for being right. In a bear market, noise feels like signal because every scary headline fits the fear. This is why people buy near tops and sell near bottoms. Not because they are stupid, but because their brains are doing what brains evolved to do. They try to reduce uncertainty with a narrative. Jesse Livermore learned this the hard way more than once. He made fortunes and lost them. I am not romantic about it. His story is a case study in how leverage and psychology can amplify each other. Leverage is borrowed exposure. It increases gains and it increases losses. It also increases emotional volatility, which is the swing in your confidence and fear. Under leverage, small market moves feel personal. You stop managing a position and you start defending an identity. One reason uncertainty breaks decision-making is loss aversion. Loss aversion means a loss hurts more than an equal gain feels good. In plain English, losing $10,000 hurts more than making $10,000 feels good. That pain pushes people into two opposite mistakes. They cut winners early to lock in relief, and they hold losers too long to avoid admitting the loss. The market does not care about your need for relief. It only cares about clearing prices. Another trap is overconfidence. Overconfidence is when your confidence exceeds your actual accuracy. It tends to rise after a streak of wins. The problem is that markets have clustering. Clustering means good times and bad times tend to group together. A streak can be skill or it can be the regime. When the regime changes, the same behavior that got rewarded gets punished. That is how risk of ruin creeps in. Risk of ruin is the probability you hit a loss so large you cannot recover. It is not about being wrong. It is about being wrong while sized too big. Think about 2008. Many smart people understood housing was stretched. The hard part was timing, and the harder part was surviving until the thesis paid. Tail risk is the risk of rare extreme outcomes, the kind that sit in the tails of the distribution. In 2008, the tail showed up. Correlation, which is how assets move together, went toward one. Diversification failed when you needed it most because everyone was selling what they could, not what they wanted. Liquidity risk is the risk you cannot exit at a reasonable price. In stress, liquidity is not a feature. It is a privilege. This is where decision-making under uncertainty becomes practical. I ask myself two questions. First, what is my edge? Edge is a small, repeatable advantage in expected value. Expected value is the average outcome if you could repeat the same decision many times. Second, what is my exposure to being wrong? Not emotionally wrong, financially wrong. If I am wrong, how bad can it get? George Soros is famous for thinking in terms of reflexivity. Reflexivity means prices can change fundamentals, and fundamentals can change prices, creating feedback loops. In a reflexive market, your model of cause and effect can fail because participants react to the price itself. That is why bubbles form. It is also why crashes accelerate. People do not just respond to reality, they respond to each other, responding to reality. In that environment, the cleanest psychological skill is humility with a spine. Humility means I accept I can be wrong. A spine means I still act, but I act with controlled sizing and clear exit logic. This is not about predicting perfectly. It is about designing decisions that are survivable. Let me bring in a different kind of case study. Nick Leeson at Barings. This was not just a trader taking a view. It was a control failure. A control is a process that prevents one person from hiding risk. Incentives matter. If a desk is rewarded for short-term profits and punished for admitting losses, you create a system that breeds concealment. Under uncertainty, people protect careers before they protect capital. That is not a moral judgment. It is a base rate. Base rates are the historical frequencies of events in similar situations. The base rate for hidden losses in weak control environments is not zero. When I think about uncertainty, I think about how humans react to stress. Under stress, we narrow attention. We anchor. Anchoring is when the first number you see becomes a reference point, like buying a stock at 100 and feeling it must return to 100. The market does not know your entry. Your entry is not a law of nature, it is a receipt. We also fall into confirmation bias. Confirmation bias is the habit of seeking information that supports what we already believe. In markets, that means you curate your feed to match your position. The trade becomes a worldview. That is when you stop updating. Updating is the act of changing your probabilities as new information arrives. Ray Dalio talks a lot about being radically open-minded. I do not need the slogan. I need the practice. I need a process that forces me to ask, what would I believe if I did not already have this position? Paul Tudor Jones is often associated with the idea that defense comes first. I interpret that as drawdown control. A drawdown is the peak to trough decline in your account. Drawdowns are not just math. They change behavior. A 10% drawdown is annoying. A 30% drawdown can change your time horizon. A 50% drawdown can change your identity. The deeper the drawdown, the more likely you abandon a good process at the worst time. So the psychological game is partly about keeping drawdowns small enough that you can keep thinking. This is where position sizing becomes psychology. Position sizing is how big you bet relative to your capital. Most people treat it like an afterthought. It is the main thing. If you size too big, you will not follow your plan. You will flinch. You will rationalize. You will average down without a reason. You will move stops. You will turn a trade into an investment, then turn an investment into a prayer. Some people hear the word Kelly criterion and think it is a magic formula. Kelly criterion is a sizing rule that maximizes long-run growth based on edge and odds. In plain English, it tells you how much to bet when you actually know your advantage. The catch is that in real markets, your edge is uncertain and your estimates are noisy. So full Kelly can be suicidal. That is why many professionals use a fraction. The point is not the formula. The point is respecting estimation error. Estimation error is how wrong your inputs can be. Under uncertainty, your inputs are always more wrong than you want to admit. Warren Buffett and Charlie Munger built a whole philosophy around staying within a circle of competence. Circle of competence is the set of things you understand well enough to judge risk. The psychological benefit is huge. You reduce false precision. False precision is when you use detailed numbers to hide the fact you do not know. If I cannot explain the risk in plain language, I do not understand it. If I do not understand it, I should not size it like I do. Stanley Druckenmiller is known for pressing when conditions align. Pressing means increasing exposure when the odds look best. The psychological danger is that people press after they feel good, not after they have an edge. Feeling good is not a signal. It is often a contrarian indicator. The professional version of pressing is conditional. It depends on liquidity, volatility, and the cost of being wrong. Volatility is how much prices tend to move around. High volatility is not automatically bad, but it raises the price of mistakes. When volatility rises, your position size should usually fall if your goal is survival. That sounds boring. It is also the difference between staying in the game and being forced out at the bottom. Under uncertainty, I also watch my need to act. Action bias is the urge to do something, anything, to reduce discomfort. Markets exploit action bias because they offer infinite buttons to press. Sometimes the best decision is to do less, not because I am passive, but because I am conserving optionality. Optionality is the value of keeping choices open. Cash can be optionality. A small position can be optionality. A hedge can be optionality. Hedging is taking a position that offsets losses in another position. It is not free. It has carry costs. Carry is the ongoing cost of holding a position, like option decay or negative yield. The psychology of hedging is tricky because it feels bad in calm markets. You pay for protection and nothing happens. Then the storm hits and you are grateful you paid. Most people cannot stick with that. They cancel insurance right before the fire. So what does good decision-making under uncertainty look like in real time? It looks like admitting what you do not know. It looks like defining what would change your mind.